Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks gain, powered by Korea, with the Kospi flying into a bull market as Lee Jae-Myung secures a convincing win in the nation's presidential election. Metal exporters gird for the worst as 50% US tariffs on steel and aluminium come into effect. But the UK secures an exemption. Plus, doubling down, Elon Musk describing President Trump's tax bill as a massive pork-filled abomination. So those Trump tariffs on steel, aluminium are now in place. Apart from the UK, of course, negotiations between the EU and the US continue. Not much progress, it seems, as they count down, of course, to that July deadline. Currently about 10% tariffs, of course, imposed on European goods, at least for now. European futures looking to add to the modest gains of yesterday, pointing high by 0.2% as we build up to the open here this Wednesday. FTSE 100 futures here in the UK with that exemption largely unaffected, it seems, in terms of the market pricing around the steel story. Currently flat on the FTSE 100. S&P futures, after 2 days of gains, pointing lower just by 0.1%. NASDAQ 100 futures, after a solid day yesterday, currently a little softer by 0.1%. You had the jobs data in terms of job openings out of the US coming in higher than expected, so suggesting that there is still that resilience in the labour market of the US, and that lifted the equity story and the stock story on Wall Street yesterday to close higher. Futures, though, pointing a little softer. We have non-farm payrolls, of course, on Friday that will round out the picture in terms of the labour market stateside. Let's flip the board and have a look cross-asset then. The focus leading up, of course, to the ECB decision, fully expected to cut again tomorrow. Euro-dollar at 1.13. In terms of the benchmark US 10-year, currently yielding 4.45. Relative stability across the Treasury market in the session today. Copper futures in focus for us today as the read across on those tariffs, of course, focused on steel and aluminium, but we know that the Trump administration is scrutinising copper as well. Potentially tariffs could be coming for that metal. Currently gaining 0.8% in terms of futures. Brent slightly softer after the gains that we've seen in recent days, $65 a barrel, currently down 0.4%. A lot of activity over in Asia, though. Let's cross over to Avril Hong in Singapore with a focus on some consumer softness out of China, but also, of course, South Korea and strength in the equity market there.
Absolutely. As you said earlier, it is on track for a bull market, the South Korean gauge, the Kospi, but we're seeing it positive across much of Asia as well. This idea of U.S. jobs market resilience, and that's helping to feed through into the chip stocks as well that are tracking gains in their U.S. counterparts as this continued return of the AI trade gets underway. And of course, even though investors seem to be digesting the metals tariffs that have gone into effect, there's also still some optimism of this easing in tariff tension. So this is what you're seeing across the board. I would just highlight the stock of Toyota Industries, part of the Toyota group, because it's received a buyout offer of $33 billion that is seen as severely undervaluing the company. So that's getting punished by investors, 12+% down, the biggest loser on the region's benchmark today. Okay, on Korea, let's take a look at how the Kospi has been faring in the past year. Certainly, as we see it, recovering from the April lows. This was a lot to do with investors looking for value, and today the jump is helped along by the companies that are related to financial firms that are seen as benefiting from the new president's reform agenda. The investor community, I think, is now going to be really focused on the implementation of his pledges of corporate reform. Don't forget, this is also a president that on the campaign trail had a pledge of getting the Kospi to 5,000. He didn't say when, but certainly this shows the emphasis he has on the stock market. For the board, take a look at South Korea bonds as well, because it really shows us how these long-end concerns are filtering through globally in South Korea, no exception. Today, the 10-year bond futures dropped to the lowest level since January. It kind of coincided with a 30-year auction out of Korea, which saw not great demand, but it's also against the backdrop of this expansionary fiscal policy from the new administration that could potentially potentially mean more bond supply. And don't forget, this is coming a day before that 30-year bond auction out of Japan. Now, keeping an eye on the Korean won as well, helped along by the easing in political risk. But what is really key to watch is the U.S. trade policy and where the currency is kind of in the mix when it comes to some of these tariff negotiations. Tom.
OK, Avra Hong in Singapore, thank you very much indeed. And we'll stay on the tariff story because, of course, just in the last hour or so, those additional tariffs have come into place on steel and aluminium. And President Trump's order doubling those tariffs on those metals to 50%, from 25% to 50%, now in effect. For now, the UK steel tariffs will remain at 25%, so a carve-out for the UK, at least for now. The White House says the move will help protect American jobs and domestic industries.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost, and the president saved that company, he saved those jobs, and he's saving that community, and that's the intention of the steel tariffs, which he will sign later this afternoon.
OK, for more, let's bring in Bloomberg's editor, John Herskovitz, for the details. John, what is the rationale that the Trump administration is pointing to for this increase in tariffs from 25% to 50% on steel and aluminium?
As you mentioned before, this was part of the Trump administration's plan to save jobs, protect the industry. But the backdrop of this comes from a deal that has been in the works for some time with Nippon Steel trying to acquire U.S. Steel. The Biden administration opposed this deal. Trump also opposed this deal, and on the campaign trail said this wasn't going to happen. But there was a turnabout last week where Trump said that the acquisition would go ahead. I'm sorry, that the investment would go ahead from Nippon Steel, but the company would be U.S. owned, U.S. operated. And as part of the way to make this more amenable for the Nippon Steel emergence into U.S. Steel, Trump said that this announced these tariffs of increasing them to 50%. He also said that the Nippon Steel deal would help protect U.S. jobs and that there would be modernization of the steel works for U.S. Steel. So it's against this this political trade issue that's been going on for some time, the change of tack for the Trump administration, and to help this deal go forward, he's putting more protections on the U.S. steel and aluminum industries.
And meanwhile, the conversations we sense are continuing between Beijing and Washington. We know that President Trump is angling for a conversation, for a phone call with President Xi Jinping. So far, that has not been confirmed. But the Secretary of State for the Treasury, Scott Bessent, commenting and saying that China needs to be a reliable partner. How are those comments likely to go down in Beijing?
Probably not all that well. Beijing has responded with Wang Yi, the foreign minister, speaking to the new U.S. ambassador, criticizing the Trump administration for not going forward, for making it more difficult for the trade negotiations to go forward. Both sides have been exchanging accusations about reneging or hurting the deal that they reached a few weeks ago in Geneva, which helped bring the tariffs down for both. And the idea of a phone conversation has been going on for some time. I think that Trump wants Xi to make to call first. Xi Jinping has shown no inclination to do this. So the two sides are just increasing the rhetoric. They're not getting any closer. And one thing that we've reported on, Bloomberg reported on, is that a lot of Chinese firms, manufacturers, have been preparing for this, trying to decrease their dependency on the U.S. market, supply chains. The story talked about what the firms are doing to make, after learning from the first Trump administration about the trade difficulties, to lessen the blow this time around. So corporate China is a little bit more prepared for what's coming down the road than happened previously.
OK, so those are the international divisions between China and the US, and no closing of that gap, at least for now. There are domestic divisions as well, and this comes down to the tax policies, of course, and the bill being pushed through the Senate, or at least looked at and scrutinised by the Senate right now. But the criticism coming from Elon Musk, blasting President Trump's signature tax bill as, quote, a budget-busting abomination. This in a public clash with the US leader following his departure, of course, from the administration. The White House downplaying those remarks from Musk. Take a listen.
The president already knows where Elon Musk stood on this bill. It doesn't change the president's opinion. This is one big, beautiful bill, and he's sticking to it.
Yeah, well, Musk does not see it as a beautiful bill. How significant is this split, John?
I think it represents a falling out between the two of them after the end of Musk's term at the Department of Government Efficiency. Musk made it very clear what he thinks of the bill. And this also reflects the concern of a lot of Republican senators who see this bill as adding several $1 trillion to the U.S. debt over the next decade. And this is something that Musk tried to eliminate with his Doge department. Whether the cuts actually come through as he promised is another thing. But yeah, we see a division between these two people who were very close a few months ago, now going separate ways. And there's some things in the bill which could hurt Musk's industries, especially Tesla, in terms of support for electric vehicles and the grid to charge them across the U.S., which may not be a part of the final legislation and could hurt the growth of his company. So two people who were really close a while ago and now going on separate paths, and Musk making it very clear what he thinks about the bill.
Yeah, and many who predicted, of course, before Musk took that role at Doge, there would be a split at some point with President Trump. It seems maybe we are at that point now. We'll continue to monitor that story. Bloomberg's John Herskovich, thank you very much indeed for that comprehensive look at what's happening in terms of the tax bill, of course, the spending bill out of the US, and the latest in terms of tariffs and trade tensions. Now, data showing a surprisingly healthy US labour market, boosting sentiment in yesterday's session. So far, the tariff story has not eroded significantly, it seems, the labour market. Meanwhile, Fed officials repeating their wait-and-see mantra amid the tariff uncertainty.
These were the last reports coming in before the tariffs. So now they're just question marks. Is that going to are the tariffs going to have a small impact, or are the tariffs going to have a large impact? And now we're just kind of we gotta wait and see.
OK, for more, let's bring in Bloomberg's Valerie Teitel. And Valerie, the comments from Goolsbee there seem to be shored up as well by the data on the jobs front, seem to give more security, or at least more evidence and more support for the view from Fed officials that they are in a position where they can hold and they can wait, because there is still that resilience, it seems, in the labour market.
Yeah, exactly. Those JOLTS data yesterday, again, reflecting that the labour market, at least in the month of April, was quite resilient. There was an unexpected rise in job openings. Also saw hiring pick up in the month of April. But note, this is the month of April. This is when equities was down 20%. There was a huge bearishness around U.S. economic growth. So the market really taking this as a positive that the labor market held up quite well. We did see this really help out the equity market yesterday. The S&P 500 jumped some 0.6% after this strong data. We're now less than 4% away from those all-time highs in the broader S&P 500 index. But while there was a big reaction in the equity market, we're continuing to not see very much movement on the expectation for Fed pricing this year. The market is still pricing in 2 cuts for the remainder of the year. So there hasn't been a lot of move here, but where there has been some action, Tom, is in options pricing. We're seeing a wide dispersion of bets on this on the Federal Reserve path changing. Some positioning for no cuts at all in 2025. Some positioning for a series of 50 basis point cuts into the end of the year. And I think this just reflects that there is a thought out there that once the Fed is done waiting and seeing for further clarity, once they get that clarity, there'll be a big shift in their communication to the markets. There might be a big shift in the Fed funds futures after that kind of clarity. And we wait for more hard data to come. We do have more on the labor market this week. We have jobless claims on Thursday ahead of the non-farm payroll print on Friday for the month of May. The market is very much attuned to see how the U.S. economy is holding up due to this tariff uncertainty.
Yeah, and what that non-farm payroll data does to that divergence that you pointed to in terms of expectations. concerns around the Fed. Thank you. Bloomberg's Valerie Totel, of course, walking through the market action and reaction to the labour market data with a throw ahead to non-farm payrolls on Friday. Here's what to think about later today, though. 9 a.m. UK time, Euro area PMI. The final print will come out. Services and composite. This, of course, ahead of the ECB's decision tomorrow when they are expected to cut rates by another 25 basis points. Don't forget that inflation in the Eurozone got to that 2% level yesterday. So the ECB is on that path again to cut tomorrow. But the services data will be important. 9 a.m. UK time. 2:45 p.m. the Bank of Canada rate decision. That comes, of course, amid the trade tensions with the US. We'll break that for you. And at 3 p.m. towards the latter end, at the back half of the day, 3 p.m. UK time, ISM Services Index out of the US. A focus on travel and leisure and whether or not services as a sector is continuing to hold up given the concerns about the economy in the US. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go, of course, on the terminal. Coming up, Korean stocks head towards a bull market following the election of the new president. We're going to bring you the latest, plus the return of super return. We will join Kriti Gupta live in Berlin, where she's going to be speaking to Permira's Credit's David Hirschmann. The focus on private equity and credit. That conversation coming up. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
The risk was a downside surprise, the reality an upside surprise.
The shock has affected outcomes.
There's a pretty big cliff from an economic perspective.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
American exceptionalism continues.
This is not what we're going to experience in the upcoming months. Is it going to be Biden data or Trump data?
The May Jobs Report, Friday on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, South Korea's new president has pledged to revive economic momentum following 6 months of political chaos spurred by his predecessor's martial law declaration back in December. Take a listen.
민생 회복과 경제 살리기부터 시작하겠습니다.
I will begin with restoring people's livelihoods and reviving the economy. With the mindset of fighting against a decisive battle against the recession, I will form an emergency economic response task force. With government funding acting as a catalyst, we will restore the virtuous cycle of the economy.
And in terms of what's happening in South Korea, that focus as well on upside for Korean equities by the new president, lifting stocks in the session today. The Kospi is up 2.5%. The economy, of course, of South Korea is challenged. They have the conversations with the Trump administration around trade and potentially as well reaching out to North Korea at some point for talks there in terms of the geopolitics and the tension between the North and the South. Let's cross over right now to our Seoul studio and bring in Bloomberg's Denny Thomas. Denny, what do we know about the new president of South Korea?
So the good news today for everybody is that South Korea finally has a new president, and people are hoping that we are over the hump in terms of the uncertainty, and everybody seems to be cheering. The markets are up, and Kospi, which is the benchmark stock, is almost hitting into a bull market territory. So for today, as Lee Jae-Myung, who has come in and he has kind of has said that he's going to revive the economy. He'll try to unify the country, and those are the two of his big commitments that he's put forward. But I think as he steps into the new job, you will find that there are the economy is in a much more tricky situation, and the whole Trump tax levies are going to be a big problem that he has to deal with. And in the campaign, he has been pretty vocal about the need to have a meaningful discussion and not rush to a conversation and a deal with the US. So those are the issues that Lee Jae-Myung will face as he gets into the hot seat.
OK, so you touch on some of the issues that he is going to face, this new president. The focus clearly on the economy as well. And he's talked about the fact that he wants to also focus on making sure that the declaration of martial law can't happen again, or at least as easily as his, of course, controversial predecessor. In terms of the economic picture of South Korea, where do we see? Is it a cost of living crisis? Is it a housing crisis? The chaebol's not producing? What is being prescribed as the things that need to be fixed within that economy?
Yeah, so I think the problem has been that as the inflation shot up with other economies, the central bank had to raise interest rates, and they were a bit slow to bring it down, and that has meant that the economy has kind of gone back. And added to that, the 6 months of uncertainty has further weighed on the consumer sentiment, and as a result, as you see that the Bank of Korea last week came out and drastically cut the growth outlook to say that this year the economy is going to only grow by 0.8%. This is also taking into account the slowdown that they expect from the export front, because almost 40% of South Korea's GDP comes from exports, and with all the tariff talk that is going on, the country will be one of the worst hit for one of the US's closest allies. So that is the broad picture, and on one end, the housing market has continued to kind of grow and boom because Seoul is the only city that a lot of people are migrating, and that has kept the demand high. But that apart, the consumption story is down, the export story is weakening, and it is going to even get worse for the exporters as all the tariffs kick in. So that is where the big picture is.
Okay. Bloomberg's Danny Thomas, thank you very much indeed. Joining us out of Seoul, the election of the new president, the challenges he faces, of course, the focus on the economy and trade conversations with the Trump administration. There's plenty more coming up. I'm going to do a deep dive on the UK's defence position as well. That is coming up later in the show. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Wednesday. Now, some other stories making the news. The US trade representative has sent letters to trading partners to remind them of the deadline for tariff negotiations to conclude. The White House says the letters are a friendly reminder and the president expects good deals. Reuters earlier reported that the administration drafted a letter demanding countries provide their best offers no later than today. Trump Media and Technology Group appears to be one step closer to launching an exchange-traded fund tied to Bitcoin. NYSE Group filed regulatory paperwork to list the Truth Social Bitcoin ETF yesterday, using the name of President Trump's social network. Truth Social's likely entry to the market sees it join a crowded field of crypto offerings in the retail space, and arguably raises some questions about conflict of interest. Crowdstrike shares dropped after its revenue forecast for the current quarter missed analyst estimates. The stock fell as much as 6% in extended trading despite beating earnings expectations. Last month, the cybersecurity company said it is aiming to generate $10 billion in annual recurring revenue. And Meta has announced it will buy power from Constellation nuclear plant, a Constellation nuclear plant, to help meet its AI energy demands. It signed a 20-year contract to buy over 1,100 megawatts from the biggest US nuclear operator starting in mid-2027. Meta is contracting for more power after its total electricity consumption nearly tripled between 2019 and 2023. And Germany's new government is reportedly planning a €46 billion corporate tax break package to stimulate its stagnant economy. According to the Financial Times, Finance Minister Lars Klingbeil will outline the measures at a cabinet meeting on Wednesday. The initiative is part of a larger strategy by Chancellor Friedrich Merz to revive the economy. Let's check in on the markets. Then you saw tepid gains across European stocks by the end of the close yesterday. European futures looking to build on that today, despite the fact that those additional tariffs have come into place on steel and aluminium, being raised from 25% to 50%. Those Trump tariffs on metals are now in place. FTSE 100 futures pointing to modest gains of 0.1%. S&P futures after a solid day yesterday for the S&P 500 and the NASDAQ currently flat, range bound. Similar picture for the NASDAQ 100. Coming up, we're going to join Kriti Gupta live at super return in Berlin. We're going to be speaking to Permira Credit's David Hirschmann. This is Bloomberg. Good Wednesday morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Asian stocks gain powered by Korea, with the Kospi flying towards a bull market as Lee Jae-Myung secures a convincing win in the nation's presidential election. Metal exporters gird for the worst as 50% US tariffs on steel and aluminium come into effect, but the UK secures an exemption. Plus, super returns to Berlin as 2025 proves to be a rollercoaster year for private markets. We're going to bring you some big-name interviews throughout the morning, and in fact in just the next couple of minutes. Let's check in on the markets. Before we get there, Redhead crossing the terminal right now. Rémy Cointreau, the drinks maker, of course, withdrawing its 2029 to 2030 guidance. We know, of course, the tariff impact is proving a challenge for drink makers generally. The China story, as well as the consumer remains challenged in that key market, has also been a headwind for some of these companies. We'll continue to keep across that story for you, but that is one to watch at the open. Rémy Cointreau withdrawing their 2029 to 30 guidance. European markets looking to build on the modest gains of yesterday, up 0.3%. FTSE 100 futures currently flat. We have the ECB decision, of course, tomorrow, expected to cut another 25 basis points. US futures currently range-bound after a decent session yesterday, closing high by around 0.4% on the S&P 500, currently just flat for that index. Nasdaq 100 futures after a decent gain as well yesterday, currently pointing lower by 0.1%. Let's briefly check in cross-asset. The Treasury market's relatively stable. We still have expectations that the Fed will cut about 2 times this year, though we know there are, of course, divisions within those expectations. The jobs data, the JOLTS data, the job openings data yesterday, better than expected. Non-farm payrolls is the next one to watch on Friday. 4.44 on the benchmark 10-year. Euro-dollar at 1.13. Copper in focus on the steel and aluminium tariffs, because we know the Trump administration is also considering potentially levies on that metal, up 0.8% in the session today. And Brent, a little softer, down 0.5 on oil at $65 a barrel. Now, private capital firms have seen deals dry up and their stocks plunge on the back of those global trade ruptures. With the backdrop of these simmering tensions, leaders in the private capital space are gathering at Super Return Berlin. It is the industry's, of course, biggest forum, and Bloomberg's Kriti Gupta is on the ground for us. Kriti.
Tom, thank you so much. It's a fascinating conversation, a fascinating time to be here, because day in, day out, we talk about the volatility in these markets. We talk about where investors want to allocate, the United States or Europe. And right here in the heart of Berlin, we are there having that exact conversation, allocating to Europe, allocating to the private market, specifically allocating to credit, and just how long that trend can last. I've got the perfect guest for you this morning, David Hirschmann from Permira's credit team, the co-head there, joining us this morning. The firm as a whole overseeing about $90 billion in terms of AUM. He himself over $20 billion. So again, a fascinating person to have this morning. David, a pleasure to have you as always on the program. We have to start with talking about this MAGA versus mega trend, if we can. This idea here simply that nobody wants to touch the U.S. anymore, maybe not invest with the same enthusiasm they did 2 years ago. Why?
So I wouldn't say that nobody wants to invest in the U.S. anymore, but for sure, for non-U.S. investors, there is a shift of focus and renewed interest for Europe. A few years ago, there was really sort of a very clear difference, and the US was or appeared to be more attractive than Europe, mainly driven by GDP growth in the US versus Europe, and a sense of instability in various European markets. I think that sentiment has changed, and this is mainly the result of the global trade war, the risk, the tariffs, although not knowing exactly what the impact will be. But Europe certainly appears more attractive now on a relative value basis, hence the renewed interest. And also because there is, in our view, and I think investors' view, stability, less volatility, especially when you look at European mid-market companies. And we find growth and really attractive opportunities in that space. And that's what we tell investors. Investors can see that as well.
Well, talk to us about that bull case for Europe then, because you used a key word, which is that relative value trade. And I'm curious how long, how sustainable that bull case is for Europe, as opposed to it perhaps just being a reaction function to the instability you're seeing in the States. How are you thinking about that?
Yeah, I mean, you're right. I mean, I'm sure there's kind of a quick knee-jerk reaction, and therefore, you know, the relative value, you can only measure it in the long term. But investors look at long-term track record of private assets managers, and what an asset class and a manager in the asset class is delivering over 10 to 20 years. That's what we show our investors, a track record over 20 years, and delivering the stability, the yield, especially investing in credit. We're not looking for, you know, equity upside. We're delivering a constant yield year on year. And over the last 18, 20 years, we've been through a number of periods of volatility. And in that context, we can show the very low default rate, the extremely low loss rate that we're able to deliver by being careful in selecting sectors, assets, portfolio monitoring, managing the portfolio. And I think that's what investors see now as well, with the downside protection versus the US, slightly better yield in some cases, and just, you know, more certainty and stability in the markets.
It's fascinating. Talk to us a little bit, let's zero in on the credit aspect of those private markets as well. I think private markets in general have been the golden child for, I want to say, the last couple of years, at least, on the expectation that there would be some sort of capital market opening up. It was supposed to happen in 2024, it got pushed to 2025. Before we get into the dynamics of the credit space specifically, is there any indication from your vantage point of when the capital markets are suddenly going to be open again?
Yeah, that's obviously that's the key question, and that's what everybody's wondering. What's interesting is that there is less M&A activity generally in the large cap space than people are hoping for and were expecting maybe at the start of the year. But the flip side of that is when there is less organic growth in a slower growth environment, value creation in sponsor-led transactions comes from M&A activity, add-on acquisitions. So we find that there is more M&A activity in the buy and build, the bolt-on acquisitions, therefore in the mid-market, than in large cap space. Now, having said that, investors are clearly also very focused on DPI, on realizations and distributions, and clearly there is pressure on GPs to realize assets and distribute the money back to investors. And for that, you're right, there needs to be an opening, even more so opening of the capital markets.
It's fascinating. I think we're all waiting to see when that happens. I think the New York Stock Exchange President Lynn Martin had then pushed that back to, that timeline back to the back half of the year. We'll see if it gets pushed back further.
Yeah.
This is now your time to shine in the credit space here. There are warnings across the board from the likes of Jamie Dimon, Connie Johnson at EQT, saying that private markets are, well, not private markets, but private credit specifically, are unregulated. They're a little bit of a gray area. They're kind of taking over perhaps the lending capacity that the banks had, say, 10 years ago or so. Walk us through what that looks like for you. Is private credit something we should be worried about?
So what's interesting is, totally agree with the point you're making, that private debt has replaced bank financing in the traditional sense, and especially in the mid-market in Europe versus 10 years ago. That's definitely the case. Now, whether there is a systemic risk and something to be worried about, one thing I don't agree with is that the industry is not regulated. It's a highly regulated industry. There is a lot of transparency from private debt managers and private asset managers in general with their investors. These are private transactions, but there is a lot of information shared with our investors, and that's true not just for us, but generally in the market. And then onto the systemic risk. I think there is much less systemic risk between the private debt players among themselves than between banks. And so some players disappear from the market because they struggle to raise a new fund. That does not affect the other players in the market.
Very quickly, I'm going to put you on the spot. What does that red flag look like? At what point do you get worried?
Well, we get worried when people lower their underwriting discipline and start to deploy a lot of capital without doing due diligence because they are under pressure to deploy, and in particular this may be true for publicly listed companies. If it's an AUM game, their objective, number one objective, is to deploy capital to grow their AUM because that's what their shareholders want to see, and that may be at the expense of a good credit underwriting discipline.
All right, David Hirschmann over at Permira Credit joining us in Berlin this morning. Tom, it's a fascinating conversation here. This is what we're talking about, the core of it, not just the volatility emanating from the United States, not just the European trade, but those capital markets and whether private credit is still the golden child of private markets. Back to you.
Yeah, excellent questions, and of course a great conversation as well. Plenty more coming up as well. Bloomberg's Kriti Gupta on the ground for us at Super Return in Berlin, and as I mentioned, we have plenty of big interviews still to come from that event, including Jim Zelter, president of Apollo Global Management, Joanna Scarf, head of European private equity at Neuberger Berman, Thomas Nides, vice chairman of Blackstone, and Connor Teskey, president of Brookfield Asset Management. So some fantastic conversations still upcoming live, of course, from Super Return in Berlin. Let's bring you some updates now and some breaking news. This is a Bloomberg scoop focused on Airbus. China considering placing orders potentially between 2 to 500, potentially up to 500 Airbus jets when European leaders are in Beijing in July. This is Bloomberg reporting. The conversations between Beijing and its European partners and Airbus are apparently ongoing. Nothing is certain yet, but the reporting suggests that this could be an offer, could be a deal that would come to the fore during that visit by key European leaders to Beijing to mark 50 years of diplomacy. So Airbus could benefit from orders between 200 and 500, both narrow-body and wide-body aircraft. And, of course, this could also be an opportunity for President Xi Jinping to make a pretty clear message on trade to his US counterpart, President Trump. Of course, Boeing has been challenged in the Chinese market. So watch Airbus at the open. This is a Bloomberg scoop on orders of between 2 to 500 jets by Chinese airlines, potentially in the offing when European leaders visit China in July. Now, some other stories making news this Wednesday. Virgin Australia, talking of airlines, is reported to have set its IPO price at $2.90 a share. That is according to the Australian Financial Review, which says the company is planning to raise around $440 million. Private equity firm Bain Capital bought Virgin Australia in 2020 following its collapse at the start of the pandemic. Toyota Industries shares slumped after the Japanese company revealed a $33 billion bid to take it private. The deal would rank among the biggest buyouts on record, but investors and analysts are arguing it significantly undervalues the company. The privatization would give Akio Toyoda greater influence over the automaker founded by his grandfather. Volkswagen is planning to reduce its German workforce by about 20,000 employees through voluntary departures. Europe's largest car maker is restructuring in response to rising costs, weaker European demand and increased competition from Chinese car makers. In December, the company struck a deal with unions to slash production and reduce headcount by 35,000 by the end of the decade. Coming up, after the UK announces an always-on munitions production capacity, we'll ask how the country can fund its increasing defence aspirations. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the White House has confirmed that President Trump will attend the upcoming NATO summit at The Hague at the end of this month. Trump has said he wants members of the alliance to spend 5% of GDP on the military, in what would amount, of course, to a substantial increase from current levels. Joining me now from Berlin is Bloomberg's Ollie Krug. Ollie, this is significant, isn't it, given all the question marks around Trump's support for the NATO alliance?
Yeah, and I don't think you would have ever had any kind of shift on this scale had basically Trump not threatened to do that. And I think that that's something that most European leaders here acknowledge. And, you know, the question is whether or not these European leaders are going to, in fact, hit that 5% target, if that is going to be the formal commitment put forward by NATO in saying that this is basically what we're willing to do here on the European side in order to guarantee continued support from the United States. And we already have, from our reporting, what we understand, some steps in that direction. We understand that the European air defense capacities, we should say NATO defense ministers, are meeting tomorrow in Brussels to discuss this very plan. They want to quintuple their air defense capabilities over the next few years just on the European flank of NATO. That is one of the initiatives that puts us on that path towards that 5% figure. And we should say Mark Rutte has openly talked about that 5% figure. We have Friedrich Merz here in Germany, who has basically committed Germany to that 5% figure. And in fact, Marco Rubio, last time he was in Brussels, talked about the United States committing itself to that 5% figure of NATO defense spending. We should say that about 3.5% of that would be traditional military spending. Another 1.5% of that is a bit of a fudge. It would be infrastructure that supports military spending, so like roads and cybersecurity, trains, for example. You know, Germany would be a big throughway to try to actually move that hardware. You need roads and trains that can carry that kind of equipment. And all of this, Tom, as you say, now that we have the formal commitment from the White House that Trump will be arriving in The Hague in what feels a little bit, Tom, like an audition for NATO, for the Europeans saying, hey, listen, we're still relevant. Please continue to have our back. Here's what we're willing to do.
At the time, of course, when we're reminded of the political divisions in Europe, and notably, of course, in the Netherlands, where the Dutch government, of course, collapsed yesterday after the far-right lawmaker Geert Wilders pulled his Freedom Party out of the ruling coalition. Let's take a listen, and we'll get back to you, Ollie.
In recent days, I have repeatedly informed all four party leaders that, in my opinion, the fall of the cabinet was unnecessary and irresponsible. We face significant national and international challenges, and decisiveness is required more than ever. This is crucial for the security of our resilience and the economy in a rapidly changing world.
So hearing there from the outgoing Dutch Prime Minister after the coalition partner, of course, Geert Wilders, pulled his party out of the coalition. That was the Prime Minister now in a caretaker capacity as they lead up, of course, to elections in the Netherlands. Ollie, what happens next for the Dutch government? What are we watching for next? Is this all about the build-up to the vote? And what is the split likely to be going forward?
Yeah, so listen, Tom, when you look at the sort of polling right now in terms of what the anticipation of this next government would be, you still have Geert Wilders, the Freedom Party, the sort of far-right anti-Islam, anti-immigration party, still polling over at #1. But what I think is really interesting is when you look back kind of historically at what's been going on with the Dutch government, this is a place that has been very, very politically unstable. You had an election back in 2021. It took 300 days, almost 299 days, to form a government. And that government held until 2023. That government then collapsed. 7 months went by to form another government, and then that government held this latest one for only 11 months and then collapsed once again. But again, Tom, the important context here is what we have not had over the last couple of years is this kind of situation in which the Europeans need to show some kind of solidarity. They are 3 weeks away from this NATO meeting where Trump is going to show up into the host country, the Netherlands, that does not have a government, and 5 weeks away from a tariff deadline where the Europeans need to be consolidated and projecting strength in order to negotiate a deal. That is not what we're getting from the Netherlands, and in fact, it's not what we got from Poland a couple of days ago either.
OK, Bloomberg's Oliver Crook, thank you very much indeed. Staying on the question of defence, we talked about NATO there with Ollie. Bloomberg learning that UK Prime Minister Keir Starmer is considering a Ministry of Defence request to back NATO's proposed new military spending target of 3.5% of national output by 2032. If accepted, it would be a major test of the UK's already stretched public finances, of course. I'm joined now by Bloomberg's Caroline Hepker, an anchor on Bloomberg Radio, who's been digging deep into the defence story of the UK. Caroline, thanks for joining us on set. You've been doing some fantastic reporting, worth reading on the terminal and online as well. Can the UK meet its requirements, meet these commitments? Where do we stand in terms of our defence capabilities?
We are a long way off 5%. Currently, Britain is spending 2.3% on its military. The government has committed to 2.5% by 2027. 3% is only an ambition, according to the Prime Minister, and that's by 2034, the end of the next Parliament. So 5% by 2032 is just an enormous task. I spent the last month speaking to defence primes. These are the biggest contractors here in the UK, to SMEs, to think tanks, to some former military chiefs also about the enormous challenge. Britain has been slashing its military spending over the decades, basically since a peak in the early 1950s. There was a huge cut in 2021 to the numbers of military personnel that we have in the UK. So there is a massive amount of ground to be made up. For example, I spoke to the former head of the Royal Navy, that's Alan West, who now sits in the Lords. So it's Admiral Lord West. He talked about the cupboard being bare when it comes to UK weapons, and that the hollowing out has been catastrophic in the UK. How do we make up that ground? Enormously difficult political decisions to be made. As part of the reporting that we've done, I went, for example, to see a factory making munitions in the north of England for BAE Systems, which is a major defence contractor for the MOD. They are bringing on more capacity, but that's because of prior agreements. They want more commitments now, and it's really about whether the government can come up with the additional defence spending. What are they going to cut? You know, most of the money that has been taken or not used for defence has been deployed into the welfare state. Voters say that they want more security and they're in favour of greater defence spending. They don't necessarily want to pay for it. And the government is now really in a very, very difficult spot. Does it increase borrowing? Bloomberg Economics says that it would have to, potentially, to meet this kind of demand. That would mean running the gauntlet with bond investors, or do they make that impossible choice with voters and have to tell them that they have to raise taxes?
OK, the ambition there, the gap is needed to be closed, and it is huge. The reporting is excellent and a deep dive and well worth your time as well. Bloomberg's Caroline Hepker, of course, anchor on Bloomberg Radio with a focus on the UK defence challenges and the need, of course, to close a sizable gap with that on-the-ground reporting. There's plenty more coming up. Stay with us. This is Bloomberg. Top line, the data on the job story stateside yesterday was positive in terms of job openings, coming higher than expected, in fact. So 7.4 million additional openings, and hiring actually picked up. If you're looking for a fly in the ointment, maybe look at the quits rate, maybe look at the number of layoffs as well that climbed to its highest since October. That takes us, of course, to Friday, when we get the non-farm payrolls data, which will round out the picture in terms of this labour market. Estimates coming through from the Bloomberg analysis suggesting that you could see a slowdown in terms of non-farm payrolls from about 180,000 to about 130,000, with the May data dropping on Friday. Let's briefly check in and give you a preview of the services story stateside as well. So we get the ISM services data out later today. You're expected to see a modest improvement with a focus on leisure and hospitality. You could see a bit of a tick up. 52 is the number that's being forecast, an increase for the month of May from 51.6 in April. Bloomberg Economics say part of that is down, of course, to the reprieve that came through from those additional China tariffs. 90-day reprieve. We're counting down to the end of that, of course, and the trade tensions are still there. So going forward, there's still a lot of uncertainty, but maybe you might see a bit of a pickup in terms of leisure and hospitality when it comes to the services sector of the US. That data dropping later today. Now, a reminder, we have got some big interviews still to come from Berlin. Super return, of course, back on the ground in Berlin. Kriti Gupta is there. She's going to be speaking to a number of big names within that space, private credit, private equity, including Apollo President Jim Zelter. That is coming up later. The opening trade is up next. This is Bloomberg.